But one of the things that we talk a lot about, Andrew, and looking back over the last 5 or 6 years, is how could multifamily go up any higher? What's your outlook on that? I mean, are you buying right now? Or are you sitting on your hands? Like, what do you think?
We're net buyers right now. And kind of actually starting at the end, you mentioned that we're selling something. We're selling properties in Atlanta right now, just because we hit our pro forma timeline, and we were like, you know what, it does make sense to take some chips off the table occasionally. And it's been a really interesting process, because I thought that most of the bids were just going to be people like, just like, so it's only 132 units, so it's not like a massive property. And we thought a lot of the bids were going to be people just like overly anxious just to get a deal, or because this property is kind of within reach for a lot of people. That was not the case at all. Out of the 25 legitimate offers that we had, at least 20 of them were from very large, extremely well funded, very sophisticated groups that own 10, 15, 20,000 units. And they're getting their hands on as much multifamily real estate as they possibly can. So that kind of made me stop and think, well, all right, if these people, these groups are that confident in multifamily, then that helps give us confidence that it still makes sense to buy the right properties in the right locations. And so we are still doing that. Inflation, the right types of inflation do tend to benefit multifamily real estate in particular. Lots of hard assets, but multifamily in particular tends to benefit from that. And so we are trying to buy as much good multifamily as we can without lowering our standards for acquisition. So what that's meant is we are averaging having to analyze 220 deals to make 28 offers to win one, right? But that one that we do win, we have high confidence that that's going to be a great property for the next five, plus years or whatever.
Oh, what do you mean by good inflation versus bad inflation? And what is your outlook on inflation, and how does that impact real estate?
Well, if I knew the exact answer to all of that, I'd be worth more than Musk, Gates, and Bezos combined. And but since I don't have my own rocket to space yet, that tells you that I'm not quite there. Um, when I say good inflation and bad inflation, that I should probably clarify that. "Quote unquote" good inflation for real estate is the type of inflation where we have wages are going up, meaning tenants can afford to pay higher levels of rent, and the cost of building is going up, right? Again, there's other negative ramifications of this, but this is from the perspective of a landlord, right? So as the cost of labor goes up, as the cost of building goes up, the value of the properties themselves go up, and therefore, prices go up. And then as wages go up, tenants can afford to pay higher rent, which leads to increasing net operating income. And as anyone who's listened to you for a while knows, net operating income is what largely drives the value of your property, right? That's good inflation. I would say bad inflation, or the biggest scenario that I see as the potential biggest risk, is a situation where we have significantly rising interest rates without the corresponding rise of wages and costs, right? Because that means your net operating income is not going up. But if interest rates do go up, then that means one of two things has to happen to sell a building. That means you're either going to have to sell it for a lower price, or the investors are going to have to accept a lower yield. So that would be the one situation that I would see as the biggest risk. And there's ways to mitigate that. But that's how I would say inflation that's bad for real estate is rising rates with flat wages and flat income. Good for real estate is rising wages and income.
So Andrew, that's such a great analysis of, inflation. But talk to me about how you guys are actually structuring your deals around that, as far as your capital stack. Like, what does that look like nowadays? Are you guys doing fixed rate? Are you guys going floating? Where are you guys hedging your risk?
Yeah, you touched on a really key piece of it, right? The wrong debt and the right property goes together about as well as microwaves and tinfoil, right? I mean, they can really screw each other up if you don't marriage that properly. So, how we're mitigating it, on the most recent property that we closed, we actually went with 12-year fixed Fannie Mae debt. And you might say, well, are you going to hold that thing for 12 years? Then not the plan. No, but here's why, because that debt gives us a good exit almost no matter what happens with the market. Here's why. With 12-year Fannie Mae debt, you can get 2 supplemental loans. So if we get 3 years down the road and we want to pull some cash out, we can. And by the way, our business plan is to hold this property for 6 years. When we go to sell in year 5 or year 6, a buyer can come in and assume our low interest rate loan. So let's say we're in a market where interest rates have gone way up, right? A buyer can come in and say, oh, hey, instead of getting my own loan at 6%, I'm going to take over yours at 3.7, get a supplemental. I have a low blended rate. And because of that extra supplemental, that buyer can get all the way back up to 75% leverage. So we're not getting hurt on having to have a buyer bring in a ton of leverage. So they can keep our low rate and get the leverage. So it's the best of both worlds for the buyer. What happens if interest rates are somehow down when we go to sell in 6 years? Okay, well, that means we're going to pay some yield maintenance or basically prepayment penalty on that loan. But if rates are somehow down 5 years from now, that probably means cap rates are also lower, which means the valuation of that property is probably going to be even higher. And we're probably going to be more than happy to go ahead and pay that yield maintenance. Worst case scenario, 5, 6 years from now, somehow the market is in a horrible place. Prices are way down. We can't, it doesn't make sense to sell or refinance. We can hold for up to 6 more years and ride it out, right? So that's one example. And there are ways to do this type of stuff with bridge debt too, but that is one example of structuring your debt with your business plan to give you a good exit almost no matter what happens.
So this is the thing. We're not in the risk avoidance business. We're in the risk management business. That's
Yes.
the definition of entrepreneurship. And a lot of people confuse us like, oh my gosh, what happens if this, what happens to that? Well, if you want to avoid it, then you sit there and you watch news all day long, right? Then you avoid it entirely. You said it's all about mitigating. You said, hey, we win whether or not this or that happens. It gives us flexibility. We don't know what's going to happen, though it's our business to kind of figure out what the probabilities are, right? And so you talked about the right kind of debt on this, and it's, in the beginning, it was just like, well, we're just going to lock in the 10-year fixed debt at 5.5% because how can it possibly go lower? Because in the beginning you don't think through these things, but you want to think through those things. And again, you do think in probabilities. And one of the things that I think people are concerned with is interest rates going up. Now, you just said that, oh my gosh, the next 18, 24 months is not likely to go up. Okay, that's great. And then what, right? What is the risk and what is the mitigation of the risk if interest rates were to spike up? And you talked about this bad inflation, right? If interest rates goes up and wages go up and inflation goes up and the rents keep going up, well, then we can preserve that return that we're looking for somehow, right? And so, what is talking in probabilities, like as you're underwriting deals, how are you mitigating that possibility, or how strongly are you mitigating that possibility based on what you're seeing in the next 5 years?
So 3 things come to mind. One, we already talked about structuring the debt to mitigate it. The other 2 things that immediately pop into my mind as to how to mitigate that are your rent growth assumptions and your exit cap rate, right? So on rent growth, what we do is we look at, take a market like Savannah, for example. We look at the historical rent growth for the last 10 years, and then we look at the future projected rent growth for the next 10 years and see what those 2 numbers are, and then we will put our pro forma rent growth somewhere a little bit significantly below that, right? So, if you look, okay, and actually, I'll switch markets. So we were looking at a property in Augusta, Georgia. For the last 5 or 6 years, rent growth there has been above 4%. For the next 2 years in this submarket, it was projected to be 7 to 8%, and then it just kind of slowly trails off after that. So what we did is we took basically that 20-year average, and the 20-year average was in the high, I forget what the number was, but we pro-formed it at 2.5, right? Saying, well, if we got a 20-year average that's well above this number, and we assume a 2.5, and it's almost never been below 2.5, that is a realistic assumption, right? Everybody who talks about multifamily these days talks about conservative assumptions and conservative underwriting, but no one actually says exactly what that means. To me, that's what that is. Like saying, hey, my 10-year average is 3, we're going to pro forma 2.5. And if it ends up at 3.5, you look like a hero. But if projections are wrong and it ends up a little bit low, you're still at least meeting your numbers, right? The second is exit cap rate, right? And cap rates are kind of this woo-woo confusing thing everyone gets all worked up about. When you're buying, especially if you're doing value add, candidly, don't worry that much about cap rates. Look at your cash flow, your internal rate of return, your equity multiple, all those things that are real dollars in the bank, right? Cap rate is really more a measure of market sentiment, right? How excited and eager are investors willing to be to purchase the cash flow that comes from a multifamily property? So how do you use cap rate to mitigate risk? One way that you do that is when you're buying a property, regardless of the state that it's in, whether it's value add, stabilized, or whatever, find out what the cap rate would be for that property in today's market if it were fully stabilized and fully marketed, right? So, let's say you're buying a 1985 property in Atlanta, and someone was, and if that property was fully stabilized and listed for 6 weeks, 37 offers, all that, okay, well, this might trade at a 4 cap. And so then what you do is you take that number. You're not using that 4 cap to determine your purchase price. You're using it to determine your exit, right? So how you mitigate the risk of rising interest rates and rising cap rates, you use that 4 as a starting point, and then add 10 basis points, or some people do 15, we do 10, add 10 basis points of cap rate expansion for every year that you're going to hold the property. So if you plan on holding it for 5 years, you're going to underwrite to a 4.5% cap rate on the exit. So what does that do? Well, that significantly lowers your projected sales price from what it would be if you were at a 4 cap. So that's how you mitigate. What's one way to mitigate the rising rates and cap rate? And guess what? If those cap rates don't go up, again, you're a hero at the end because you're going to just blow away your projections. If they do go up, well, hey, you planned for it. You're hitting your numbers. So all these little things added together are what make for, what I like to say, realistic and risk mitigated underwriting.